For more on whether the election euphoria can last and what's next for the markets, let's bring in Bessemer Trust Chief Investment Officer Rebecca Patterson. Rebecca, always nice to see you. You've heard the debate here on the desk.
Yeah.
What do you do with this rally? Do you believe in this rally? Do you fade this rally? Or do you think stocks are going to go higher?
Just to kind of pick up where we left off, October to me was completely overdone. You have global growth at 3%. You have U.S. growth that's decelerating, but still in the threes. So to have the market pricing in recession in October, to me, felt like a mismatch. So to bounce back, I think it makes sense. And then if we have buybacks kicking in again, I saw one report today suggesting November buybacks would be the strongest ever on record for the month. I mean, that's a big support for the market. That could last. Seasonals can help. The trade thing I do think is meaningful. I think our best case scenario, Dan, I agree with you. The best case scenario is that they agree to talk. So we have a constructive direction, but no resolution. And the worst case scenario is that Pence brings a deal and Trump says not good enough, and then we're back to square one and we realize they can't even agree within the White House. That's, to me, how I'm scenarioing it, but I think that's kind of icing on the cake. I go back to, what does the president want? He wants GDP growth to stay in the threes until 2020, which is hard to do without more stimulus and with the Fed raising rates. Having a trade war doesn't help him in his goal. So I'm not suggesting it's going to get resolved quickly, but he has to balance out the trade war versus keeping growth high enough that he can campaign on that.
And I mean, I completely see where you believe there is sort of a Trump put underneath the economy and that he wants to keep it at 3%. But it's so much harder to do when you have the Democrats controlling the House. So how does he make sure that put is the floor?
I mean, aside from just jawboning the stock market or giving some positive developments here and there on China or something, I don't know, because he doesn't control the Fed. Maybe he'd like to, but he doesn't. And I think they're on a path. And unless growth slows meaningfully, they're going to stay on that path. And at a certain point, to what you all are saying, that does start impacting profit margins. It starts impacting corporate debt servicing. So I look out at the next year, year and a half, and if this rally keeps going, I think it's probably an opportunity to take a little off the table with a medium-term view.
Is there any mechanism by which they can delay the tariffs if they do think there's a chance for constructive dialogue?
I mean, I think there's lots of things they could do. One possible scenario would be right now the $200 billion in goods, the tariffs at 10%. Right now it's scheduled to go up to 25% in January. They could hit the pause button and just say, okay, we're staying at 10%, and as long as negotiations are constructive, that's all we have. That also gives U.S. businesses more time to figure out what they do in case tariffs go up. This has happened really fast. For a company to adjust supply chains and processes for a 25% tariff, it's not a lot of time. So if they can just stall, U.S. companies can figure it out or possibly figure it out, which can help sustain growth.
So, Rebecca, then stalling and pausing means we probably have to face all this in the first quarter of next year. And so while you don't invest month to month, you're thinking longer term. How would you handicap the first quarter of the year, especially in a world where things have slowed down a little bit? In other words, do you feel that we could be in a more constructive place having worked through some of this, or do you get probably a little bit more cautious into the new year saying, hey, we may be okay for now?
I mean, if we have a melt up like we had today into year end, I think you're greedy if you just count on it continuing all through Q1. But China has put in a ton of stimulus into the market, cutting interest rates, fiscal stimulus. Eventually, that should feed through, and the growth slowdown hopefully will turn into a stabilization. Yep. That's really good news regardless of trade. The buybacks continue. We shouldn't forget the fiscal stimulus, while next year it's smaller than this year, there's still a lot out there. We had $300 billion spending package for this year and next year. Half of that comes through next year. So I don't think growth suddenly goes to a halt. But do people look at that, the fact that we still have good growth, it should support earnings, and a slower rate doesn't mean doom, it just means a slower rate? Or do people focus on that second derivative and get out because the pace is decelerating? I think I'm in the former camp, but with the Fed continuing to remove liquidity and starting in January, the European Central Bank is also going to stop adding liquidity. The volatility bouts are likely to get more, not less. So I do think even if Q1 is okay, taking a little off the table when we get those better levels, if you're taking a medium-term view on your capital, is probably the right way to go. Now, if you're more speculative trader, a shorter-term trader, I mean, like right now, we were talking before we got on about China. Yeah. We've had a great entry level to add some China risk if you think there's a possibility of a positive trade development in the next month.
Rebecca, thank you.
No, my
Good
pleasure.
to see you. Rebecca Patterson of Bessemer. So what do you do, Steve?
You finally have competition with stocks. You have the Fed raising rates in 3 different ways. Quantitative tightening. They're paying for the tax plan. They're selling treasuries, $2 trillion in treasuries. They're lifting rates. They're raising rates. I think at this point, if you do get a lift in the market, you use it to make sales.